Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
So our focus today is LFMD, Inc., and it's a stock that really perfectly encapsulates the brutal volatility and, the complex risk-reward calculus of the direct-to-consumer telehealth sector, especially in that exploding GLP-1 weight management space. This is not a simple value proposition. It is a battleground, and we really have to start with the market mechanics. As of late December 2025, LFMD is trading deep in the $3 to $4 range. And that's following an absolutely brutal and immediate crash around 44% in the sessions right after its Q2 2025 earnings release. That immediate investor reaction tells you pretty much everything you need to know about the crisis of confidence. But for those looking at a potential turnaround, the microstructure data is it's screaming for attention. We are looking at approximately 4.86 million shares held short. That's over 12% of the tradable flow. And crucially, a days to cover ratio that has spiked as high as 11.5 days. So that means it would take nearly 2 full trading weeks for shorts to exit their positions under average volume. So the question we really have to ask ourselves is this: is the market's current distress valuation warranted, making this a definitive value trap because of operational failures and, significant legal risk? Or does the aggressive institutional accumulation and the strategic de-risking of the balance sheet suggest the market is fundamentally mispricing a deep value opportunity? I'm going to argue that the sophisticated money is betting on an explosive recovery.
Well, I come at it from a different perspective. That high short interest in days to cover ratio, that merely describes potential energy. It doesn't guarantee movement at all. I would argue that the current depressed price is a completely rational reflection of two things. First, the structural operational flaws that came out of that Q2 crisis. And second, the really profound technical headwinds that are actively suppressing the stock. Look, this is a speculative value trap, and the current price is simply the reality of a business that fundamentally failed to execute on its most important pivot.
I still maintain that the market is getting way too hung up on the Q2 execution errors and is, missing the forest for the trees. The valuation disconnect here is, it's just staggering. Management has guided for $250 million to $255 million in revenue for 2025. Yet the current market capitalization is only around $155 million. That's a company trading at less than 60% of its projected revenue. Sophisticated institutional investors, the so-called smart money, they're clearly seeing this gap, and they're acting on it.
And what does that institutional action look like exactly?
It looks like aggressive accumulation, particularly in Q2 and Q3 of 2025, right as the stock was collapsing. Look at the numbers. UBS Group AG increased its position by a staggering 1,103%. Nuveen LLC wasn't far behind. They increased by 310%. And Morgan Stanley actually doubled its stake. So institutional ownership now stands at over 51% of the company, which establishes a powerful, a fundamental floor for the stock. These investors are buying the future platform, not the Q2 earnings miss. And this confidence is reinforced by management's strategic de-risking. They completed the full divestiture of the non-core WorkSimpli SaaS business in late 2025 to become a pure-play telehealth entity. And maybe most importantly, they paid off all outstanding debt during Q3 2025. Zero debt, $250 million in revenue potential, and institutional conviction. That is the definition of a deep value opportunity.
That is a compelling story, but institutional money is not infallible. They can be early and they can certainly be wrong. My perspective is really anchored by the crisis of confidence that was generated by those Q2 2025 results. This was not a minor temporary glitch. It was a fundamental structural exposure. The $62.2 million in revenue was a miss on analyst consensus, and the EPS loss of -6 cents. That was a 200% negative earnings surprise. A 200% negative earnings surprise is not just a miss, that's an absolute demolition of confidence. And the root cause was the operational flaw in the aggressive GLP-1 pivot driven by what they termed a higher than anticipated refund rate. We have to explore the financial mechanism of that failure because it's just so damning.
You're referring to the prior authorization difficulties?
Precisely. The company made promises that patients would get insurance-covered weight loss drugs, but the pharmacy benefit managers, the PBMs, which, act as the gatekeepers for insurance coverage, they immediately tightened their prior authorization criteria and just started denying patients access. So the patients, understandably, they churned immediately and demanded a refund of their initial subscription fees. Now, just think about the mathematics of this failure for a second. LifeMD had already incurred the customer acquisition cost, or CAC, to bring that patient in, plus the clinical cost for the virtual doctor consult. They then had to return the revenue they were supposed to earn. In simple terms, they paid money to acquire a customer only to then pay more money to refund them. This created negative gross margins on those specific patient cohorts.
A business model that actively pays to lose customers is fundamentally broken. And that breakage is exactly what the 44% crash reflected.
Okay, I see why you emphasize that execution error, but let me give you a different perspective on the GLP-1 strategy itself. You focus on the mechanism of failure, but I'm focusing on the strategic intent and the immense long-term opportunity. The operational glitch, the refund crisis, is a fixable issue in the patient onboarding funnel. It's a process failure, not a fatal flaw in the long-term telehealth infrastructure. And furthermore, the Novo Nordisk collaboration, that's the manufacturer of branded drugs like Wegovy, is essential external validation. It distances LifeMD from the gray market and positions them to address a total addressable market that remains immense, conservatively valued at $100 billion. So yes, they miscalculated the speed at which PBMs would tighten the screws. But that is market friction, not a fatal business flaw. They are making the necessary adjustments to their patient targeting. That aggressive discounted pricing, like the $199 introductory offer, can also be framed as a necessary loss leader. They are acquiring patients cheaply now, even if some churn, to build a competitive moat and acquire millions of records for the broader LifeMD ecosystem for the long run.
I'm sorry, but I just don't buy that it's simply a fixable glitch. Let me tell you why. If your marketing promise is fundamentally undermined by external gatekeepers, the PBMs, and that results in the immediate negative gross margin we just discussed, then the core unit economic model is broken until insurance criteria ease or you dramatically change your pricing strategy to rely less on insurance coverage, which fundamentally alters your entire TAM. The partnership with Novo Nordisk is, well, it's great for optics, but if you can't translate that branded access into profitable, retained subscriptions because of these insurance bottlenecks, it is economically irrelevant to the current valuation. Optics don't pay the bills, and this operational exposure brings us directly to the profound technical hurdles that compound the fundamental risk, hurdles that institutional shorts are exploiting.
The stock is currently characterized by a definitive death cross formation, meaning the 50-day simple moving average crossed below the 200-day SMA. This is a classic bearish indicator. The stock is trading well below that 200-day average, which now sits as a major resistance level in the, let's say, $3.85 to $4 zone. Any rally up to that mark is likely to be met with heavy selling pressure. But speaking of sophisticated funds, we have to talk about the microstructure data. We see that 38.18% of the short volume is executed off exchange in what we call dark pools.
Okay, hold on. For listeners who aren't, deep in the weeds on microstructure, why does that 38% matter? It's just a number, right?
Well, it matters because dark pools allow large institutional short sellers, the hedge funds, to execute huge bearish positions discreetly, away from the public order book. This is fundamentally about price suppression. It tells you the big players aren't just passively betting against LFMD. They are actively and systematically trying to prevent the price from rising above that critical $4 resistance. They are building a massive gravity well over the stock, and you can have a perfect fundamental turnaround, but if that short gravity is too heavy, the stock just cannot lift off.
That's a compelling point regarding the technical resistance, I'll give you that. But you are focusing entirely on the downward pressure while completely ignoring the latent energy created by that exact same short base. We established that the days to cover ratio has spiked as high as 11.5 days. That is an extremely high reading.
implying a severe liquidity trap. For context, anything over 10 days is considered a hair trigger setup. So here is the thesis. If management delivers any positive fundamental catalyst, the Q4 report showing those refund rates have normalized, or maybe a resolution to the Hagens-Berman lawsuit, short sellers would find it mathematically impossible to cover their 4.86 million short shares without driving the price up exponentially. The setup for a short squeeze is basically it's structurally perfect, regardless of how many dark pool transactions they executed to suppress the price temporarily. Once the momentum shifts, that high short interest becomes pure jet fuel. And furthermore, even within the technical picture, we are seeing hints. The MACD, the Moving Average Convergence Divergence Indicator, is showing a slight positive divergence of 0.11, which suggests that downward selling pressure may finally be exhausting itself.
Exhaustion or just a slight pause before the next leg down? That's the question. I think we need to look beyond the immediate technicals and really address the long-term credibility of the management team that's supposed to be guiding this turnaround.
You're referring to the corporate history?
Yes. Critics point to the long history of strategic pivots and corporate name changes, Immutidine to Conversion Labs to LifeMD, and the 1-for-5 reverse stock split back in 2020. They see this as a management team that's focused more on capital engineering and accessing new money than on delivering consistent, high-quality operational results. They see opportunism.
I would frame that history very differently. I'd call it corporate agility and a sophisticated ability to navigate changing capital markets. This is the management team that successfully executed a crucial NASDAQ uplisting and accessed the deep institutional capital that is now accumulating the stock. They are survivors who have successfully pivoted away from saturated markets and positioned the company within the highest growth sector of the healthcare industry. Their willingness to execute a major divestiture, work simply, shows they're willing to shed profitable safety nets for a higher multiple future. That is focused leadership.
Agility or opportunism, that's the core disagreement that defines the trust deficit, isn't it? The history of pivots combined with the pending securities litigation where insiders are alleged to have sold stock during the class period makes investors wary. You can't just pivot away from credibility concerns, and the operational problems, I'd argue, extend well beyond the volatile GLP-1 segment. In Q 2025, management had to admit to temporary elevated customer acquisition costs for the core RexMD business.
But those costs were clearly tied to market adjustments.
But when your flagship, high-volume brand starts seeing a sustained spike in CAC and simultaneously your gross margin contracts, even slightly, down to 88%, it's a classic red flag that the high-volume model is reaching market saturation and the unit economics are decaying. Why should investors trust future growth projections in the unproven GLP-1 segment when the core engine, RexMD, is sputtering and management has historically overpromised? Evidenced by the massive 200% earnings surprise miss? That history justifies the current skepticism.
I acknowledge that the declining gross margin in the core segment is certainly a point of concern. But you have to look at the significant streamlining measures that are already bearing fruit, proving management's ability to adapt. The divestiture of Work Simply, which was a stable business. It generated $3.7 million in adjusted EBD in Q2 2025, was a deliberate, necessary move.
It removed a safety net, yes.
It did, but it positioned LifeMD as a pure-play healthcare sector company, positioning it for higher valuation multiples once execution stabilizes. And we are already seeing early evidence of stabilization. The Q3 2025 financials showed adjusted EBITDA rose 20% year over year to $5.1 million. This is proof that cost control, the debt pay down, and the strategic focus are working, despite the Q2 headwinds. Institutional investors are buying the future potential of a debt-free, focused healthcare platform, and they're anticipating that the operational glitches will be resolved.
Look, I absolutely acknowledge the debt repayment and the positive Q3 adjusted EBITDA. Those are genuine mitigating factors that prevented the stock from falling even further. However, the market demands consistent, clean execution, and LifeMD just hasn't proven it can deliver that yet. The core operational risks, specifically the unresolved refund dynamics and the high customer acquisition costs that threaten their unit economics, combined with the active securities litigation and the trust deficit, make LFMD an extremely high-risk, speculative stock.
And from a tactical standpoint, the technical picture remains definitively bearish, trading deep within a death cross formation. Caution is mandatory until the stock can consistently reclaim key resistance levels, particularly the 200-day simple moving average around 385. Until that happens, the risk of a technical breakdown below the critical support level of 320 remains far too high to ignore.
And I return to the compelling divergence between fundamentals and valuation. We have a company guided to deliver over $250 million in revenue, trading at a fraction of that, now operating with zero debt. The fact that sophisticated funds like UBS and Morgan Stanley are accumulating the stock while it is trading near its lows, following debt elimination and a pure play pivot into a $100 billion market, it just suggests that the market's focus on Q2's temporary execution glitches is short-sighted and excessive. The confluence of strong institutional ownership, which is acting as a major ballast, and that high days-to-cover ratio of 11.5 days makes LFMD a potent turnaround candidate positioned for a potentially explosive recovery when the fundamental narrative finally shifts. This is a classic, high-reward risk setup for long-term holders who are willing to withstand the volatility.
Ultimately, LifeMD's trajectory will depend entirely on management delivering consecutive clean quarters, free of refund surprises. That's what will validate either the institutional bullishness or the sustained skepticism we've discussed.
I agree. This stock is currently a high beta speculation where both sides have compelling, data-backed arguments derived directly from the material. The complexity truly requires investors to understand both the structural vulnerabilities, the operational flaws, and the explosive technical potential inherent in that short base.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.